Hello, and welcome to our comprehensive guide on the different ways to invest in gold in the United States. Over the course of this series, we will journey through the multifaceted world of gold, exploring its history, its role in the modern economy, and the various methods available for individuals to gain exposure to this timeless precious metal. Our goal is to provide you with clear, educational, and unbiased information, so you can better understand the landscape of gold investing. This first chapter serves as our foundation. Before we delve into the how of investing in gold, it's essential to understand the why. Why has gold captivated humanity for millennia? Why, in an age of digital currencies and complex financial instruments, does this yellow metal still hold such a powerful allure for savers and investors alike? We'll explore the historical significance and the modern financial roles that gold plays. But before we proceed, it is absolutely crucial to state the following very clearly. The information presented in this entire series is for educational and informational purposes only. It is not, and should not be considered financial, investment, legal, or tax advice. Every individual's financial situation is unique, and any investment decision should be made only after consulting with a qualified and licensed financial advisor, a certified public accountant, or a tax professional who can assess your personal circumstances and risk tolerance. All investments carry risk, including the potential loss of principal. Past performance is not an indicator or guarantee of future results. We are not recommending or endorsing any specific product, service, or investment strategy. Our aim is simply to educate. Please conduct your own thorough research before making any financial decisions. With that important understanding in place, let's begin our exploration. Gold's story is as old as civilization itself. From the tombs of the Egyptian pharaohs to the treasure chests of Spanish galleons, gold has been a universal symbol of wealth, power, and beauty. For thousands of years, it was not just a symbol of wealth, it was wealth. It served as the primary form of currency for countless empires and nations. Its physical properties make it uniquely suited for this role. It is scarce, yet not impossibly rare. It is highly durable. The gold mined thousands of years ago still exists today. It doesn't rust or corrode. It is malleable and divisible, meaning it can be shaped into bars, coins, or jewelry without losing its intrinsic value. This long history as a medium of exchange has ingrained a deep-seated trust in gold within the human psyche, even after most of the world moved away from the gold standard. A monetary system where a country's currency was directly linked to a specific amount of gold. The metal retained its status as an ultimate store of value. It's a tangible asset, something you can physically hold, which sets it apart from stocks, bonds, or digital entries in a bank account. It doesn't rely on a government's promise to pay or a company's future earnings. Its value is inherent and recognized globally. This brings us to the modern roles of gold in a diversified investment portfolio. Why would a contemporary investor in the United States consider gold today? Financial professionals often point to four primary reasons. First, gold is widely considered a hedge against inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, the purchasing power of a currency is falling. When the value of the US dollar decreases, it takes more dollars to buy the same amount of goods. Historically, as the purchasing power of fiat currencies like the dollar declines, the price of gold tends to rise. Investors often turn to gold during inflationary periods in an attempt to preserve the value of their wealth. While other assets can be eroded by inflation, gold's price in dollar terms often adjusts to reflect the new reality of the currency's lower value. Second, gold is often viewed as a safe haven asset during times of economic or geopolitical uncertainty. When stock markets are volatile, when there is political instability, or during periods of international conflict, investors often seek refuge in assets they perceive as stable and secure. This phenomenon is often referred to as a flight to safety. Because gold's value is not tied to the performance of any single economy or corporation, it can act as an anchor in a portfolio during turbulent times. Its price may rise when other assets are falling, providing a potential buffer against market downturns. Third, gold serves as a tool for portfolio diversification. The old saying, "Don't put all your eggs in one basket," is the core principle of diversification. The goal is to own a mix of different asset classes such as stocks, bonds, and real estate that do not all move in the same direction at the same time. Historically, gold has shown a low or negative correlation with stocks and bonds. This means that the factors that cause stock prices to fall may not affect gold in the same way, and in some cases, might even cause its price to rise. By including an asset that behaves differently from the rest of the portfolio, An investor might be able to reduce overall volatility and risk. Finally, gold is a global store of value with consistent worldwide demand. The demand for gold doesn't just come from investors. A significant portion of annual gold demand comes from the jewelry industry, particularly in large markets like India and China. Furthermore, gold has critical industrial applications in electronics, dentistry, and aerospace due to its high conductivity and resistance to corrosion. This diverse demand base, spanning investment, consumer goods, and industry, provides a solid floor for its value. It's a universally accepted asset that can be easily bought or sold in virtually any country in the world. So, to summarize what we've covered in this introductory chapter, gold's appeal is rooted in its long and storied history as a trusted form of money. In the modern era, investors and financial analysts look to it for several potential benefits: as a hedge against the eroding effects of inflation, as a safe haven asset during times of market turmoil, as a means to diversify a portfolio, and as a tangible store of value with global demand. Understanding these fundamental concepts is the first and most critical step. It's not about predicting where the price of gold will go tomorrow or next year. It's about understanding the timeless role it has played and continues to play in the global financial system. As we move forward in this series, we will build upon this foundation. In our next chapter, we will begin to explore the most direct and traditional method of investing in gold: buying physical bullion. We'll discuss the different forms it comes in, such as coins and bars, what you need to know before buying, and the important considerations of storage and security. Thank you for joining us for this introduction. We hope you'll continue with us on this educational journey into the world of gold investing. Welcome back to our educational series on the different ways to invest in gold in the United States. In our first chapter, we explored the timeless appeal of gold, understanding its historical significance and its modern roles as a potential hedge against inflation, a safe haven asset, and a tool for portfolio diversification. Before we begin this chapter, we must once again emphasize that this content is for informational and educational purposes only. It is not financial, investment, or legal advice. Investing in any asset, including gold, involves risk. You should always consult with a qualified and licensed financial professional who can review your individual situation and goals before making any investment decisions. Today we delve into the most traditional and tangible method of owning gold: buying physical bullion in the form of coins and bars. For many, the appeal of this method is its directness. You are not owning a contract or a share of a company. You are in direct possession of a tangible asset with a history stretching back thousands of years. But this direct ownership comes with its own unique set of considerations. So what exactly is gold bullion? The term bullion refers to gold in a bulk form, valued purely by its weight and purity, not by its artistic design or rarity. When you hear about the price of gold on the news, they are referring to the price of bullion. This is investment-grade gold. Its purity, often called fineness, is a critical factor. You'll see it expressed as a decimal, such as 0.999, which means 99.9% pure gold, or 0.9999, which is 99.99% pure. This is also measured in carats, with 24-karat gold being the purest form. For investment purposes, you are almost always looking at 22-karat or 24-karat gold. The weight is also standardized, with the most common unit being the troy ounce, which is slightly heavier than a standard ounce. Gold bullion typically comes in two primary forms: coins and bars. Let's look at coins first. Gold coins are often the starting point for those new to physical gold. They are produced by sovereign government mints around the world. Because a government guarantees their weight and purity, they are easily recognizable and trusted globally, which makes them very liquid, meaning they are easy to buy and sell. It is vital here to distinguish between two types of gold coins: bullion coins and numismatic coins. Bullion coins, like the American gold eagle or the Canadian gold maple leaf, are valued almost entirely on their gold content. Numismatic, or collectible, coins are valued based on factors like their rarity, historical significance, and condition. Their price can be many times greater than the value of the gold they contain. While coin collecting is a fascinating hobby, it is a completely different market from investing in gold for its metallic value. For the purpose of this educational series, we are focusing strictly on bullion. Some of the most widely recognized and traded gold bullion coins in the world include the American gold eagle, which is 22-karat gold, and contains 1 troy ounce of pure gold plus a small amount of alloy for durability. Another is the Canadian gold maple leaf, known for its 0.9999 purity. Others include the South African Krugerrand, the Austrian Philharmonic, and the Australian kangaroo. These coins often come in various sizes, from 1 full troy ounce down to fractions like a half ounce, quarter ounce, or even a tenth of an ounce, making them accessible at different price points. Next, let's discuss gold bars. Gold bars, also known as ingots, serve the same purpose as bullion coins, but are often preferred by those looking to acquire larger quantities of gold. The primary advantage of bars is that they typically have a lower premium over the spot price of gold compared to coins of the same weight. What is a premium? The spot price is the current market price for raw, unrefined gold. You can never buy physical gold at the exact spot price. The premium is the additional cost that covers fabrication, refining, distribution, and the dealer's profit. Because it generally costs less to produce a single 1-ounce bar than it does to mint a detailed 1-ounce coin. The premium on the bar is usually lower. This difference becomes more significant with larger sizes. A 10-ounce bar will typically have a lower premium per ounce than 10 individual 1-ounce bars. Gold bars are produced by private refiners and mints, and they come in a vast range of sizes, from as small as 1 gram to the large 400-ounce, good delivery, bars held by central banks. When considering gold bars, it's important to look for those produced by well-known and reputable refiners, such as PMP Suisse, Valcambay, or the Perth Mint. These bars will be stamped with the refiner's name, their weight, and their purity, serving as a hallmark of authenticity. Whether you are considering coins or bars, a crucial aspect of the process is choosing where to buy them. Reputable precious metals dealers are the most common source. These can be local coin shops or large online retailers. When evaluating a dealer, factors to consider include their reputation, how long they have been in business, their buyback policies, and the transparency of their pricing. Now we must address the most significant challenge of owning physical gold: storage and security. A gold coin in your hand is valuable, but it's also vulnerable to theft. You have a few options for storage, and each has its own trade-offs. One option is home storage, perhaps in a high-quality, well-hidden safe. This gives you direct access to your gold at all times. However, it also carries the risk of theft or loss due to fire or natural disaster. It's also important to note that standard homeowners insurance policies often have very low limits for covering precious metals, so a separate, specific insurance policy or a rider may be necessary. Another common option is a safe deposit box at a bank. This provides a higher level of security against theft. The downsides include limited access during banking hours, and the fact that the contents of a safe deposit box are generally not insured by the bank or the FDIC. You would still likely need to secure your own private insurance. A third option, particularly for larger holdings, is a third-party depository. These are private, high-security vaulting facilities that specialize in storing precious metals. They are fully insured and regularly audited. While this is arguably the most secure option, it comes with storage fees and you do not have immediate physical access to your holdings. In summary, buying physical gold bullion offers the ultimate in direct, tangible ownership. Coins provide high liquidity and recognizability, while bars can offer lower premiums for larger purchases. However, this path requires careful consideration of where to buy, understanding premiums over spot price, and most importantly, establishing a secure and insured storage plan. The tangible nature of physical gold is a major draw for some, but the responsibilities it entails lead others to seek different methods. For those interested in gold's price movements without the challenges of storage, there are market-based alternatives. In our next chapter, we will explore one of the most popular and accessible of these, gold exchange-traded funds, or ETFs. Thank you for joining us. We hope you will continue on this journey in our next chapter. Hello and welcome back to our educational guide on the different ways to invest in gold in the United States. In our last chapter, we delved into the world of physical bullion, discussing the characteristics of gold coins and bars, and the important responsibilities of storage and security that come with them. Before we dive into today's topic, we must reiterate our foundational principle for this series. The information provided is for educational and informational purposes only, and should not be construed as financial, investment, tax, or legal advice. Every individual's financial circumstances are unique, and all investment decisions carry inherent risks. It is essential to consult with a qualified and licensed financial professional to determine what, if any, investments are suitable for your personal goals and risk tolerance. While holding a gold coin in your hand offers a powerful sense of ownership, the practicalities of buying, storing, and insuring physical metal are not for everyone. In response to this, the financial industry has developed ways to gain exposure to gold's price movements through the convenience of the stock market. Today, we will explore one of the most popular of these innovations: gold exchange-traded funds, or ETFs. So, what exactly is a gold ETF? Let's break it down. An ETF, or exchange-traded fund, is a type of investment fund that is traded on a stock exchange, just like the stock of a company. However, instead of representing ownership in a single corporation, an ETF holds a portfolio of assets. In the case of a gold ETF, that primary asset is physical gold bullion. Here's how it generally works. A financial institution, known as the fund sponsor, creates a trust. This trust then buys a very large quantity of physical gold bars and stores them in a secure, audited vault, often with a major bank or bullion depository. The trust then issues shares, and each share represents a fractional ownership of the gold held in the vault. These shares are then listed on a major stock exchange, like the New York Stock Exchange, where they can be bought and sold by investors throughout the trading day using a standard brokerage account. In essence, a gold ETF is designed to have its share price track the price of gold, minus any fees. The primary appeal of gold ETFs lies in their convenience and accessibility. Let's walk through some of the commonly cited advantages. First is simplicity. Investing in a gold ETF removes the logistical hurdles of physical ownership. There is no need to research dealers, worry about the authenticity of a coin or bar, or arrange for secure storage and insurance. The entire process is handled by the fund manager. Second is liquidity. Gold ETFs are highly liquid, meaning they can be easily bought and sold at or near the current market price during trading hours. This is done through the same brokerage account you might use to buy shares of any public company. Selling is as simple as clicking a button, and the cash is typically available in your account within a couple of days. This can be much quicker and simpler than finding a buyer for physical gold. Third is cost-effectiveness in transaction. Buying and selling ETF shares often involves a very low commission through a brokerage account. Furthermore, the price at which you buy or sell a share is typically very close to its underlying value, a concept known as a tight bid-ask spread. This contrasts with physical gold, which involves paying a significant premium over the spot price upon purchase. Fourth is accessibility. You can buy as little as a single share of a gold ETF, making it possible to invest in gold with a much smaller amount of capital than would be needed to buy a full-ounce coin or bar. Additionally, because they are treated like stocks, gold ETF shares can often be held in tax-advantaged retirement accounts, such as an IRA or a 401k, something that is not possible with physical bullion. However, it is crucial to understand that with these conveniences come important trade-offs and considerations. A balanced view requires looking at the potential downsides. The most significant difference is the nature of ownership. With a gold ETF, you do not own the physical gold itself. You own a financial security, a share in a trust that owns the gold. This introduces what is known as counterparty risk. You are relying on the fund sponsor and the custodian of the gold to manage their operations correctly. While these funds are heavily regulated, this indirect ownership is a fundamental distinction from holding a gold bar in your own possession. Another key factor is the expense ratio. Gold ETFs charge an annual management fee, called an expense ratio. This is a small percentage of your investment that is automatically deducted from the fund's assets each year to cover operating costs, storage, and insurance. While the fee may seem small, over many years, this can create a slight drag on performance compared to owning physical gold, which has no management fees, although it does have storage costs. Furthermore, for the vast majority of retail investors, gold ETF shares cannot be redeemed for the physical metal. The fund is designed to provide exposure to the price of gold, not to be a method for accumulating physical bullion. You are investing in the price of gold, not in the gold itself. Finally, the tax implications of gold ETFs are a complex area. In the United States, gains from selling gold ETFs are often taxed differently than gains from selling typical stocks. They can be classified as collectibles by the IRS, which may result in a higher long-term capital gains tax rate. This is a nuanced topic that can change, and it is absolutely essential to consult with a qualified tax advisor to understand the potential tax consequences. In summary, gold ETFs offer a simple, liquid, and cost-effective way to gain exposure to the price movements of gold through a standard brokerage account. They eliminate the challenges of storage and insurance associated with physical bullion. In exchange for this convenience, investors have indirect ownership, pay a small annual management fee, and must consider the specific tax treatments. The choice between physical gold and a gold ETF is not about which is better, but about which approach aligns with an individual's goals and preferences. One offers tangible ownership with direct responsibility, while the other offers market convenience with indirect exposure. ETFs track the price of gold bullion itself. But there is another way to invest in the gold sector that is tied not to the metal, but to the business of producing it. In our next chapter, we will explore the world of gold mining stocks. Thank you for joining us for this discussion on gold ETFs. We look forward to having you with us for Chapter 4. Hello and welcome back to our educational series on the different ways to invest in gold in the United States. In our previous chapters, we covered physical gold and gold ETFs, both of which are methods designed to track the price of the metal itself. Today, we are shifting our focus to a fundamentally different approach: investing in gold mining stocks. As always, we must begin with our important disclaimer. The content in this series is for informational and educational purposes only. It does not constitute financial, investment, tax, or legal advice. Investing in stocks, including those of mining companies, involves significant risk, including the potential loss of your entire investment. Please consult with a licensed and qualified financial advisor to discuss your personal financial situation and investment goals. When you buy a gold mining stock, you are not buying gold. Instead, you are buying a share of ownership in a business, a company that is involved in the complex and capital-intensive process of exploring for, developing, and operating gold mines. This distinction is the single most important concept to grasp. The success of your investment is tied not just to the price of gold, but to the operational success and financial health of the company you choose. This introduces a powerful concept known as leverage. The profitability of a gold mining company is often leveraged to the price of gold. Let's use a simplified example to illustrate this. Imagine a mining company can produce an ounce of gold for a total cost of $1,500. If the market price of gold is $1,800 per ounce, the company makes a profit of $300 per ounce. Now, let's say the price of gold increases by about 11% to $2,000 an ounce. The company's costs may stay relatively the same, so its profit per ounce jumps to $500. In this scenario, an 11% rise in the price of gold resulted in a 66% increase in the company's profit per ounce. This potential for magnified returns is what attracts many to the mining sector. Beyond this leverage, there are other potential upsides. Unlike physical gold or most gold ETFs, some established mining companies pay dividends to their shareholders, which can provide a source of income. Additionally, a well-run company can grow its value through smart business decisions, such as discovering a new, high-grade gold deposit or implementing new technology that lowers its production costs. This means it's possible for a company's stock price to increase even if the price of gold remains flat. However, the leverage that can magnify gains can also magnify losses, and this is just one of many significant risks associated with mining stocks. A balanced understanding requires a thorough look at the challenges. First and foremost are operational risks. Mining is an incredibly difficult industrial operation. Mines can face geological problems, like lower than expected ore grades. There can be equipment failures, labor strikes, and safety incidents. Any of these issues can halt production, increase costs, and severely impact the company's profitability and stock price, regardless of what the price of gold is doing. Second is management risk. The quality of a company's leadership team is critical. Poor decisions regarding which projects to develop, how much debt to take on, or how to manage cash flow can have devastating consequences for shareholders. Third is geopolitical risk. Gold is mined all over the world, and many major deposits are in countries with unstable political or legal systems. A foreign government could suddenly increase taxes or royalties on mining operations, refuse to renew essential permits, or in extreme cases, even nationalize a mine, which could wipe out a shareholder's investment. Fourth, there are input cost risks. A mining company's expenses, such as fuel for its trucks, electricity for its mills, and labor costs, can rise unexpectedly. If costs go up while the price of gold stays the same, profit margins get squeezed, which can hurt the stock price. Finally, remember that gold mining stocks are, at the end of the day, stocks. They are subject to the whims of the overall stock market. In a broad market downturn, even profitable gold mining companies can see their share prices fall as investors sell off assets across the board. It's also useful to know that the mining industry is not monolithic. Companies are often grouped into categories based on their size and stage of development. Majors are large, established companies with multiple operating mines, often in different countries. They tend to be more stable and are the most likely to pay dividends. On the other end of the spectrum are junior or exploration companies. These are typically small, speculative companies that are searching for new gold deposits. They often have no revenue at all and are very high risk, as the odds of finding an economically viable mine are very low. In conclusion, investing in gold mining stocks is an indirect and more complex way to gain exposure to the gold sector. It offers the potential for leveraged returns that can outperform the price of gold, but it comes with a substantially higher and more varied set of risks, including operational, political, and market-specific challenges. It requires analysis not just of gold, but of the intricate details of a specific business. For those who are interested in the potential of the mining sector, but are hesitant to research and select individual companies, there is another option that offers broad diversification. In our next chapter, we will explore gold mining ETFs, which allow you to invest in a basket of many different mining companies all at once. Thank you for joining us for this overview of gold mining stocks. We hope to see you in the next chapter. Hello and welcome back to our ongoing educational series on the different ways to invest in gold. In our last chapter, we took a deep dive into the world of individual gold mining stocks. We explored how they offer potential leveraged returns on the gold price, but also come with a significant and complex array of business, operational, and geopolitical risks. As we consistently emphasize, please remember that this presentation is for informational and educational purposes only. It is not intended as, and should not be taken as, financial, investment, or tax advice. Any form of investing carries risk, and the topics discussed today are no exception. We strongly encourage you to consult with a licensed financial professional who can provide guidance tailored to your specific circumstances. Researching and selecting individual mining stocks can be a demanding task, requiring in-depth analysis of financial statements, geological reports, and management teams. For individuals who are interested in the mining sector's potential but wish to avoid the risk of a single company performing poorly, there is an alternative: the gold mining ETF. Today, we will explore this popular method, which combines the concepts from our previous two chapters. A gold mining ETF is an exchange-traded fund that holds a portfolio, or basket, of shares from various gold mining companies. Instead of tracking the price of gold bullion like the ETFs we discussed in Chapter 3, these funds track the collective performance of the businesses in the gold mining industry. You are buying a single share on a stock exchange, but that one share gives you ownership in dozens, sometimes even hundreds, of different mining companies simultaneously. The most compelling reason individuals are drawn to this approach is instant diversification. As we learned in the last chapter, an investment in a single mining company can be jeopardized by a mine-specific event, like a flood or a labor strike. By spreading the investment across many different companies, a gold mining ETF mitigates this company-specific risk. The failure or underperformance of one company in the portfolio will have a much smaller impact on the overall value of the fund. Think of it this way. Instead of betting on a single horse to win a race, you are investing in the performance of many of the horses in that race. This diversification is not just across companies, but often across geographies as well. Many gold mining ETFs hold stocks of companies with operations all around the globe, from North America to Australia to Africa. This provides a level of international diversification that would be very difficult and costly for an individual investor to replicate on their own. Another significant advantage is convenience. Just like other ETFs, gold mining ETFs can be bought and sold with ease through a standard brokerage account during market hours. This simplicity allows individuals to gain broad exposure to the global gold mining industry with a single transaction, saving the immense time and effort that would be required to research, buy and manage a portfolio of dozens of individual stocks. However, it is absolutely critical to understand that while diversification can mitigate certain types of risk, it does not eliminate risk altogether. A gold mining ETF is still a collection of gold mining stocks, and therefore, it inherits all the systemic risks of the industry itself. For example, the fund is still highly leveraged to the price of gold, meaning its value is likely to be much more volatile, both on the way up and on the way down, than the price of gold bullion. Furthermore, the fund is exposed to industry-wide risks. If the price of fuel rises sharply around the world, it will increase costs for nearly every company in the portfolio, potentially hurting the ETF's overall performance. A widespread change in environmental regulations, or a shift in geopolitical sentiment towards mining would similarly affect the entire sector. Like other ETFs, gold mining ETFs also have an annual expense ratio. This management fee is charged by the fund sponsor to cover the costs of managing the portfolio. This fee is automatically deducted from the fund's assets, and will slightly reduce your net returns over time.
Disclaimer: the information presented is for informational purposes only, and is not professional financial, investment, or tax advice. All investments involve risk, and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
It's also worth noting that not all gold mining ETFs are the same. They are designed to track different indexes, and the composition of that index matters. Some funds may focus exclusively on large, established senior mining producers. Others might include a mix of mid-tier and smaller, more speculative junior exploration companies. The inclusion of these riskier junior miners can increase the fund's potential for both growth and volatility. Therefore, understanding what the ETF actually holds is an important part of the educational process. In summary, gold mining ETFs offer a convenient and diversified way to invest in the gold mining sector. They solve the problem of single-stock risk by spreading the investment across a wide range of companies. In exchange for this convenience and diversification, investors pay an annual management fee and remain exposed to the inherent volatility and systemic risks of the mining industry as a whole. So far in our series, we have covered owning gold directly and investing in the companies that mine it. We have stayed in the realm of physical assets and stock ownership. In our next chapter, we will venture into a more complex and advanced area of the market: gold futures and options contracts. Thank you for joining us for this discussion. We hope you will continue this educational journey with us. Hello, and welcome back to our comprehensive educational guide on gold. In our journey so far, we have covered direct ownership of physical gold, as well as stock market products like ETFs that track both bullion and mining companies. Today, we venture into a far more complex and advanced corner of the financial world: gold futures and options. We must begin with a more prominent warning than in any of our previous chapters. The topic of this chapter is for informational and educational purposes only, intended to provide a complete picture of the gold market. Futures and options are complex, high-risk financial instruments. They involve a substantial risk of loss, potentially more than your initial capital, and are not suitable for the vast majority of investors. This is not a guide on how to trade these instruments. We are not providing any financial or investment advice. Any consideration of these products should only be undertaken by sophisticated individuals with a very high risk tolerance, and after extensive consultation with a licensed financial advisor specializing in derivatives. With that critical understanding established, let's begin our educational overview. What is a gold futures contract? A futures contract is a standardized legal agreement to buy or sell a specific asset, in this case gold, at a predetermined price on a specific date in the future. These contracts are traded on regulated exchanges, like the COMEX in the United States. A standard gold futures contract, for example, represents 100 troy ounces of gold. The defining characteristic of futures trading is leverage. A trader can enter into a contract to control a large amount of gold, for instance 100 ounces worth, perhaps $200,000, with a relatively small amount of capital deposited with their broker. This deposit is called margin, and it is not a down payment. It is a good faith deposit to cover potential losses. This leverage is a powerful double-edged sword. It can magnify gains, but it can, and often does, magnify losses just as dramatically. For example, if a trader puts down, say, $10,000 in margin to control that $200,000 worth of gold, a mere 5% drop in the price of gold could wipe out their entire $10,000 margin, resulting in a 100% loss of their capital. If the price moves against them even further, the broker will issue a margin call, requiring the trader to deposit more funds immediately, or the position will be closed at a loss. It is possible to lose more money than was initially deposited. Futures contracts are primarily used by two groups: commercial hedgers such as mining companies or jewelers who need to lock in a future price for their product or inventory, and speculators, who are betting on the short-term direction of the gold price. Due to the extreme leverage and the need for constant market monitoring, futures trading is a high-stakes activity that is fundamentally different from long-term investing. Next, let's briefly discuss gold options. An options contract gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a specified price on or before a certain date. There are two basic types of options. A call option gives you the right to buy gold at a certain price. A person might acquire a call option if they believe the price of gold will rise. A put option gives you the right to sell gold at a certain price. A person might acquire a put option if they believe the price of gold will fall. To acquire one of these contracts, a buyer pays a premium to the seller. This premium is the cost of the option. A key difference between buying an option and trading a futures contract is the risk profile for the buyer. The absolute maximum loss an option buyer can experience is the premium they paid for the contract. Their loss is capped. This is fundamentally different from a futures contract, where losses can exceed the initial margin. However, it is vital to understand that this limited risk applies only to the buyer of the option. For an option seller, the risk profile is very different and can be unlimited. Selling options is an even more complex strategy reserved for the most sophisticated market participants. So who are these instruments for? As we have stressed, futures and options are tools for experienced, active traders and institutional investors. They are generally considered unsuitable for individuals focused on long-term wealth building, retirement savings, or those who are not prepared to dedicate significant time to monitoring the markets and potentially suffer substantial financial losses. In conclusion, gold futures and options represent a way to speculate on the price movements of gold with a high degree of leverage. Their complexity and risk profile place them in a category far removed from the investment methods we discussed in previous chapters. The purpose of this overview was simply to make you aware of their existence within the broader gold market, not to suggest them as a course of action. After exploring this high-stakes world of derivatives, our next chapter will return to more accessible and modern methods of gold ownership. We will look at a newer category of products known as digital gold and gold savings accounts, which aim to blend the convenience of modern finance with the traditional stability of gold. Thank you for joining us for this very important and cautionary chapter. We hope you will be with us for the next one. Hello and welcome back. In our last chapter, we navigated the complex, high-stakes world of gold futures and options, concluding that they are specialized instruments intended for sophisticated traders rather than long-term investors. Today, we return to more accessible methods of gold ownership as we explore a modern innovation in the precious metals market: digital gold and gold savings accounts. As we always do, we must start with our crucial reminder. This chapter and this entire series are for educational and informational purposes only. The information provided is not financial, legal, or investment advice. Newer financial products, in particular, can have unique risks and a shorter track record. It is essential to conduct thorough research and consult with a licensed financial professional before considering any investment product or service. So what is digital gold? The term generally refers to a service, often provided through a website or a mobile app, that allows you to buy and own fractional amounts of physical gold. When you purchase, say, $50 worth of digital gold, the company behind the service buys that exact amount of physical gold on your behalf. This gold is then stored in a high-security, insured vault. Your ownership is recorded in a digital account that you can access at any time. This model aims to combine the best of both worlds: the tangible security of owning real, physical gold with the ease and convenience of a modern digital transaction. Let's compare this to the methods we've already discussed. Unlike owning physical coins or bars yourself, digital gold eliminates the need for you to arrange for your own secure storage and insurance. Unlike a gold ETF, where you own shares in a trust, most digital gold providers assert that you have direct ownership of a specific, allocated amount of gold held in your name. The appeal of this model is clear. First is accessibility. The barrier to entry is extremely low. You can often start with just a few dollars and add to your holdings over time, much like a regular savings account. This allows for a strategy known as dollar-cost averaging, where you can make small, regular purchases regardless of the price. Second is convenience. The entire process of buying, selling, and tracking your holdings is typically done through a user-friendly interface on your phone or computer. Transactions are fast and simple, removing the logistical steps of dealing with a physical metals dealer. Third is the solution to the storage problem. For many, the biggest deterrent to owning physical gold is the question of where to keep it safely. Digital gold services handle the vaulting and insurance for you, which is a core part of their service. However, it is absolutely critical to balance these conveniences against the significant risks and considerations that are unique to this model. The most important of these is counterparty risk. When you use a digital gold service, you are placing your complete trust in the company providing that service. You are trusting that they are actually buying the gold they say they are, that they are storing it securely, that their records are accurate, and that the business will remain solvent and operate honorably. If the company were to fail or engage in fraudulent activity, your assets could be at risk. This shifts the risk from the physical security of your home to the financial and operational security of a third-party company. Another key consideration is the regulatory environment. While a gold ETF is a security registered with the SEC, many digital gold providers operate in a newer, sometimes less regulated space. The level of investor protection can vary, making due diligence on the part of the individual extremely important. You must also be aware of the fees. These services are not free. There are typically transaction fees for buying and selling, which is often a percentage of the amount. There may also be storage fees, which function similarly to an ETF's expense ratio, where a small percentage of your holdings is charged annually to cover vaulting and insurance. These fees should be clearly disclosed by the provider. Finally, while some services offer the ability to take physical delivery of your gold once you have accumulated a certain amount, it's important to understand the terms. There is often a minimum quantity required for redemption, such as 1 ounce, and there will be additional fees for fabrication and secure shipping. In conclusion, digital gold platforms present a modern, convenient, and highly accessible way for people to build a holding in physical gold over time. They elegantly solve the problem of storage. But this convenience comes with a critical trade-off. You are entrusting your asset to a third-party company. The entire model is built on that company's integrity and competence. So far, our focus has been entirely on gold. But gold has a well-known counterpart in the precious metals world. In our next chapter, we will take a slight detour to explore investing in silver, examining its unique characteristics and how it compares and contrasts with gold. Thank you for joining us. We hope you will continue this educational journey with us in the next chapter. Hello, and welcome back to our educational series on gold. In the last chapter, we explored the modern world of digital gold, a convenient method that also carries a heavy reliance on the provider. So far, our entire focus has been on gold. But it's nearly impossible to discuss gold for long without mentioning its famous sibling in the precious metals family, silver. Today we're going to take a brief but important detour to understand silver and how it compares and contrasts with gold. As always, we must begin by stating that this chapter is for educational and informational purposes only. We are not providing financial advice or recommending any specific asset. The goal is simply to compare the characteristics of two different metals, so you can have a more complete understanding of the precious metals landscape. For thousands of years, gold and silver were the world's two primary forms of money. They share a long and storied history as trusted stores of value. Both are tangible, finite resources that have been universally recognized for their beauty and scarcity. This shared monetary history is why they are often grouped together. However, in the modern economy, their roles have diverged significantly, and it is a mistake to think of silver as simply cheaper gold. The most fundamental difference between the two lies in their sources of demand. Gold's demand is overwhelmingly driven by its use in jewelry and as a financial asset for investment, held by individuals and central banks. While it has some industrial uses in electronics and dentistry, these make up a relatively small portion of its annual demand. Silver, on the other hand, leads a double life. It is part precious metal, part industrial metal. Over half of all silver consumed each year is used in industrial applications. Silver has the highest electrical and thermal conductivity of any metal, making it irreplaceable in a vast array of products. It is in your smartphone, your television, and your computer. It is a critical component in solar panels, electric vehicles, and countless medical devices due to its antimicrobial properties. This heavy industrial use ties silver's fate much more closely to the health of the global economy. During periods of strong economic growth, industrial production increases, and so does the demand for silver, which can put upward pressure on its price. Conversely, during a recession, manufacturing slows down, industrial demand for silver can fall, and its price can be negatively affected. Gold, in contrast, often behaves as a safe haven, with its price sometimes rising during periods of economic uncertainty as investors seek stability. This dual nature is a primary reason why silver is significantly more volatile than gold. Its price tends to experience much larger percentage swings. If the precious metals market is rising, silver often rises faster and further than gold. But when the market is falling, silver often falls faster and harder. If you think of gold as a large, steady ship navigating the financial seas, silver can be compared to a smaller, faster speedboat that is more affected by the waves of the economic cycle. Another key difference is, of course, the price. Silver is far less expensive per ounce than gold. This makes it much more accessible for individuals who want to begin accumulating a physical precious metal, but have a limited amount of capital. It is much easier to buy a few ounces of silver than it is to buy a single ounce of gold. This price difference leads to a common metric used by market observers called the gold-to-silver ratio. The ratio is simple. It's the number of ounces of silver it takes to buy 1 ounce of gold. This ratio has fluctuated throughout history. Market analysts watch this ratio to gauge the relative value of the two metals, but it's important to view it as a historical and analytical tool, not as a predictive signal for market timing. Finally, there's a practical difference to consider for those interested in physical ownership: storage. Because of its lower value density, storing a significant amount of wealth in silver takes up much more space and is much heavier than storing the same dollar value in gold. For example, storing $50,000 worth of silver would require a large, heavy box, whereas the same value in gold could fit easily in the palm of your hand. In conclusion, while silver shares a monetary heritage with gold, it is a distinctly different asset. Its heavy use in industry makes it more sensitive to the economic cycle and contributes to its higher volatility. It is not simply a less expensive version of gold, but an asset with its own unique fundamentals. Understanding these differences provides valuable context for our study of gold. Now we will return our focus to gold and examine a method of ownership specifically designed for retirement planning. In our next chapter, we will discuss gold IRAs. Thank you for joining us for this comparative look at silver. We look forward to having you with us for the next chapter. Hello and welcome back to our educational series. In our previous chapter, we took a brief detour to explore the world of silver and understand its unique properties compared to gold. Today, we return our focus to gold and delve into a topic that intersects directly with United States tax law and retirement planning: the Gold IRA. We must begin with a very direct and serious disclaimer. This chapter is for informational purposes only. It is not tax, legal, or financial advice. Individual retirement accounts, or IRAs, are governed by complex and strict rules set by the Internal Revenue Service (IRS). Making a mistake with an IRA can lead to significant taxes and penalties. Before considering any of the concepts discussed in this chapter, it is absolutely essential that you consult with a qualified financial advisor and a tax professional. First, it is important to clarify what a Gold IRA is. A Gold IRA is not a separate type of IRA. It is a self-directed IRA, or STIRA, that allows an individual to hold alternative assets, including physical precious metals, within their retirement account. A standard IRA offered by a typical brokerage firm is usually limited to paper assets like stocks, bonds, and mutual funds. A self-directed IRA gives the account holder more control and a broader range of investment options, but it also comes with greater responsibility and complexity. The structure of a Gold IRA is very different from simply buying gold. It involves several key entities, each with a specific role. First, you have the IRA custodian. This must be a financial institution, like a trust company, that is specifically approved by the IRS to handle self-directed IRAs. They are responsible for administering the account and ensuring all IRS regulations are followed. Second, there is the precious metals dealer, the company from which your IRA will purchase the gold. Third, and critically, there is the depository. This is a secure, third-party vaulting facility that is approved by the IRS to store the physical metal. Here is the most important rule to understand. The IRS strictly prohibits the IRA owner from taking personal possession of the precious metals held within their IRA. You cannot store the gold in your home or in a personal safe deposit box. Doing so would be considered a distribution from the IRA, making the value of the metals taxable and potentially subject to early withdrawal penalties. The gold must be transferred directly from the dealer to the secure depository. The IRS also has very specific rules about what kind of gold can be held in an IRA. The metal must meet minimum purity standards. For gold, this is generally 0.995 fineness, or 99.5% purity. This means that certain popular gold coins, such as the American Gold Eagle, are permitted, as are other coins like the Canadian Gold Maple Leaf and US Buffalo coins, along with bars from accredited manufacturers. However, most collectible or numismatic coins are not allowed, as their value is based on rarity rather than metal content. So how does the process typically work? An individual would first open an account with a self-directed IRA custodian that specializes in precious metals. Then they would fund the account, either by making an annual contribution or by rolling over funds from an existing retirement account, such as a 401k or another IRA. Rollovers have extremely specific rules that must be followed precisely to avoid tax consequences. Once the account is funded, the individual directs the custodian to purchase specific, IRS-approved metals from a dealer, and those metals are then delivered and stored at an approved depository. The primary benefit cited by proponents of Gold IRAs is the ability to diversify a retirement portfolio with a tangible asset, all while retaining the tax advantages of an IRA, either tax-deferred or tax-free growth. depending on whether it is a traditional or Roth account. However, the considerations and potential downsides are significant and must be understood. Gold IRAs typically come with much higher fees than standard IRAs. You can expect to encounter an account setup fee, annual administrative fees from the custodian, annual storage fees from the depository, and the premium over the spot price you pay to the dealer when you purchase the metal. These layers of costs can create a drag on your investment returns over time. Furthermore, the precious metals and styra industry requires careful navigation. It is an area where individuals must perform extensive due diligence to select reputable and trustworthy custodians and dealers. Finally, the complexity of the rules cannot be overstated. A simple mistake in the rollover process or in taking a distribution can have costly consequences. In summary, a gold IRA is a specialized retirement account that allows for the ownership of physical gold under very strict IRS regulations. It requires a multi-party structure involving a custodian and a depository, and it comes with a higher fee structure than a typical IRA. While it offers a path to holding a tangible asset in a retirement account, its complexity and costs demand careful consideration and professional guidance. Now that we have covered this formal, rule-bound method, our next chapter will return to more conventional market products. We will discuss gold-focused mutual funds and the potential for earning income through dividend-paying gold stocks. Thank you for joining us for this important chapter. We look forward to seeing you next time. Hello, and welcome back to our educational series on the different ways to invest in gold. In our last chapter, we navigated the complex, rule-bound world of gold IRAs, a specialized vehicle for holding precious metals within a retirement account. Today, we return to the more conventional landscape of the stock market to explore two related topics: gold-focused mutual funds and the potential for generating income through dividend-paying gold stocks. As we must always emphasize, the following information is for educational purposes only and is not financial or investment advice. Investing in mutual funds and stocks carries inherent risks, and any decision should be made only after careful consideration and consultation with a licensed financial professional. Let's begin with gold-focused mutual funds. Like the mining ETFs we discussed in Chapter 5, a gold mutual fund is a vehicle that pools money from many investors to buy a diversified portfolio of securities related to the precious metals industry. This typically means shares in gold and silver mining companies. However, there is a fundamental difference in how they operate. Most of the ETFs we previously discussed are passively managed. This means they are designed to automatically track a specific, predetermined market index. A gold mining ETF, for example, will simply buy the stocks that are in its target index in the same proportion. A gold mutual fund, on the other hand, is typically actively managed. This means there is a professional fund manager, often with a team of analysts, who is actively researching and making decisions about which specific stocks to buy, hold, or sell. Their goal is to use their expertise to try and outperform the market index. This active management leads to a few key differences. Proponents of mutual funds would argue that in a complex sector like mining, an expert manager can add value by identifying promising companies and avoiding troubled ones. The other side of that coin is management risk. The manager's decisions could also lead to underperformance. Another difference is in how they are priced and traded. An ETF trades on a stock exchange throughout the day, and its price fluctuates with the market. A mutual fund is priced only once per day, after the market closes, based on the total value of its holdings, a figure known as the net asset value, or NAV. These differences also extend to fees. Because of the costs associated with a professional management team, actively managed mutual funds generally have higher annual fees, known as expense ratios, than their passive ETF counterparts. Now let's shift our focus to a specific characteristic of some gold-related investments: dividends. Physical gold, as we know, does not produce any income. It doesn't pay interest or dividends. For some, this is a drawback. However, it is possible to receive a potential income stream from the gold sector by investing in the stocks of companies that pay dividends. A dividend is a distribution of a portion of a company's earnings to its shareholders. These are typically the larger, more established, and financially stable mining companies that generate consistent profits. For these businesses, paying a dividend is a way to return value to their investors. This can be appealing for individuals who are not only seeking exposure to the price of gold, but also a potential cash flow from their investment. The total return from such a stock would be a combination of any change in the stock's price plus the dividend payments received. However, it is absolutely crucial to understand that dividends are not guaranteed. They are a discretionary payment decided by the company's board of directors. A company can increase, decrease, or eliminate its dividend entirely at any time. This could happen if the price of gold falls, reducing the company's profitability, or if the company needs to preserve cash for a major new project. The dividend is a reflection of the company's health, which is still subject to all the operational, geopolitical, and market risks we discussed in Chapter 4. In summary, gold mutual funds offer an actively managed alternative to ETFs for those who value the idea of professional stock selection, though this often comes at a higher cost. Dividend-paying gold stocks, in turn, provide a way to potentially earn an income from the gold sector, but this income is not guaranteed and remains tied to the high-risk nature of the mining business. Our exploration of gold-related companies has so far focused on the miners who extract the metal from the earth. But there is another unique business model in this space that offers exposure to gold with a very different risk profile. In our next chapter, we will explore the world of gold royalty and streaming companies. Thank you for joining us. We look forward to having you with us for the next chapter. Hello and welcome back to our educational series on the different ways to invest in gold. In our last chapter, we looked at gold-focused mutual funds and the potential for income through dividend-paying stocks, both of which are tied to the business of mining. Today we're going to explore a different and unique business model within the precious metals industry: gold royalty and streaming companies. Before we begin, we must reiterate our core principle. This presentation is for informational and educational purposes only. It is not financial or investment advice. The business model we are discussing today has its own unique characteristics and risks. We strongly encourage you to consult with a licensed financial professional for guidance tailored to your individual situation. So what is a gold royalty and streaming company? It's crucial to understand that these companies are not miners. They do not own or operate mines. They don't manage huge teams of engineers and geologists, and they don't own heavy equipment. Instead, they act as specialized financiers for the mining industry. They provide mining companies with much-needed capital, and in return, they receive a long-term interest in the mine's production. This interest can take two primary forms. The first is a royalty. A royalty is a contract that gives the royalty company the right to receive a percentage of the revenue or profit from a mining operation. For example, a royalty company might give a mining company $10 million in upfront capital. In exchange, the mining company agrees to pay them 1% of the value of all the gold produced from that mine for the rest of its operational life. The second form is a stream. In a streaming agreement, the company provides a large upfront payment to a miner in exchange for the right to purchase a percentage of that mine's future gold production at a deeply discounted, fixed price. For instance, a streaming company might pay a miner $100 million upfront. In return, they get the right to buy 10% of the mine's gold production for, say, $500 an ounce, for the life of the mine. The appeal of this business model lies in its unique risk and reward profile. One of the main advantages is built-in diversification. These companies build large portfolios of royalty and streaming agreements, often with dozens or even hundreds of different mines, operated by many different mining companies, spread across the globe. This provides broad diversification in a single investment. More importantly, this model insulates them from many of the direct risks that mining companies face. Because they don't operate the mines, they are not directly exposed to rising operational costs like fuel and labor. They are not responsible for the massive capital expenditures required to build and maintain a mine, which are often subject to huge cost overruns. While they benefit from successful exploration on a property they have a royalty on, often called free upside, they don't have to pay for the exploration costs themselves. This structure can also lead to very high profit margins. In a streaming deal, for example, if the company's cost to acquire an ounce of gold is fixed at $500, and the market price of gold is $2,000, their margin is very wide. If the price of gold rises to $2,500, their cost remains the same, and their profit margin expands even further. However, it is essential to understand that this model is not risk-free. The success of a royalty or streaming company is still fundamentally tied to the success of its mining partners. If a mine that they have a royalty on experiences a major operational failure and has to shut down, the revenue from that asset stops. This is a form of counterparty risk, the risk that the mine operator will fail to deliver on its production promises. Furthermore, these companies are fully exposed to the price of gold. Their revenues are directly linked to the market price of the metal. If the price of gold falls significantly, their revenues, profits, and stock prices will be negatively impacted. Also, because they are not the operators, they have no control over the mining process. They cannot make decisions to improve a mine's efficiency or solve an operational problem. They are passive financial partners. In summary, gold royalty and streaming companies offer a unique way to invest in the gold sector. Their business model provides broad diversification and insulation from many of the direct operational and capital risks of mining. In exchange, they take on counterparty risk and remain fully exposed to the price of gold. We have now covered a wide array of investment vehicles.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
From holding the metal itself to investing in various types of gold-related companies. But how does an individual begin to analyze these options? In our next chapter, we will discuss the fundamentals of evaluating gold investments, covering key metrics and concepts that are often considered by investors in this space. Thank you for joining us for this look into a unique corner of the gold industry. We look forward to seeing you in the next chapter. Hello and welcome back to our educational series. In our last chapter, we explored the unique business model of gold royalty and streaming companies, the specialized financiers of the mining world. Having now covered a wide variety of gold-related investments, a natural question arises. How does one even begin to analyze them? Today, we will discuss some of the fundamental concepts and metrics that investors and analysts often consider when evaluating different types of gold investments. Before we proceed, it is absolutely essential to understand the purpose of this chapter. This is not a guide on how to invest, nor is it a formula for picking winners. This is a purely educational overview of common analytical concepts to help you better understand the financial landscape surrounding gold. This is not financial advice. Any investment analysis should be comprehensive and, ideally, conducted with the guidance of a qualified financial professional. Let's begin with the foundation: evaluating gold bullion itself, and by extension, products that are designed to track its price like physical gold ETFs. Since a bar of gold is not a company, its analysis is not about balance sheets or management teams. Instead, it is about understanding the large-scale macroeconomic factors that tend to influence its price. One of the most significant factors analysts watch is real interest rates. The real interest rate is the nominal interest rate minus the rate of inflation. For example, if a savings account pays a 3% interest rate, but inflation is running at 4%, the real interest rate is negative 1%. In such an environment, cash held in the bank is losing purchasing power. Gold pays no interest, but during periods of negative real interest rates, its nature as a tangible store of value can become more attractive to investors. Another key factor is the strength of the US dollar. Gold is priced in US dollars all over the world. Because of this, gold and the dollar often have an inverse relationship. When the value of the dollar falls compared to other global currencies, it takes more dollars to buy 1 ounce of gold, so the price of gold in dollar terms tends to rise. Conversely, a very strong US dollar can sometimes be a headwind for the gold price. Finally, there is the role of geopolitical and economic uncertainty. Gold has long been considered a safe haven asset. During times of global instability, political turmoil, or stock market volatility, investors may shift a portion of their assets into gold, seeking its perceived stability. This increase in demand can drive up the price. When it comes to evaluating the companies involved in the gold sector, such as mining and royalty stocks, the analysis becomes much more specific and complex. Here you are analyzing a business, so you must consider factors related to its financial health and operational efficiency. A primary consideration is a company's financial health. Analysts will often look at a company's balance sheet to assess its level of debt. The mining industry is cyclical, and a company with too much debt can become financially distressed if the price of gold falls for a prolonged period. They also look at cash flow, which is a measure of the cash a company generates from its operations. Consistent, positive cash flow is often seen as a sign of a healthy and sustainable business. For mining companies specifically, one of the most important metrics is the all-in sustaining cost, or AISC. This figure represents the total cost to produce 1 ounce of gold, including not just the direct mining and processing costs, but also administrative overhead and the costs of ongoing exploration to sustain the mines. A company with a low AISC is more profitable and more resilient. It can still make a profit even if the gold price falls, whereas a high-cost producer might become unprofitable. Other factors analysts look at include a company's mine life and reserve grade. This refers to how many years a mine is expected to operate and the quality of the gold in the ground. They will also heavily weigh jurisdictional risk, the political and financial stability of the countries where the mines are located. In summary, the evaluation process is different depending on the asset. For gold bullion, the focus is on global macroeconomic trends. For gold companies, the focus is on the financial health and operational efficiency of the business itself. This chapter has only scratched the surface of these topics, with the goal of introducing you to the concepts. Understanding these fundamentals is a crucial step, but every investment has tax implications that can affect the net return. In our next chapter, we will provide an educational overview of how different types of gold investments are generally taxed in the United States. Thank you for joining us for this look into the fundamentals of analysis. We look forward to seeing you in the next chapter. Hello and welcome back to our educational series. In our last chapter, we introduced some of the fundamental concepts that analysts use to evaluate gold and gold-related companies. Today, we will tackle one of the most critical and most complex aspects of any investment: taxation. Understanding the potential tax implications is essential, as they can have a significant impact on your net returns. We must begin with our most important disclaimer of the series. The following presentation is a simplified, general overview for educational purposes only. It is not tax advice or legal advice. Tax laws in the United States are incredibly complex. They can and do change, and their application depends entirely on your unique personal financial situation. You must consult with a qualified and licensed tax professional, such as a certified public accountant or a tax attorney, before making any financial decisions based on tax considerations. With that vital warning in place, let's explore how different gold investments are generally treated by the IRS. First, let's look at the taxation of physical gold, such as the coins and bars we discussed in Chapter 2. For tax purposes, the IRS classifies physical gold bullion as a collectible. This is the same category that includes assets like art, antiques, and rare stamps. This classification is the key to understanding its tax treatment. When you sell a collectible at a profit, that profit is considered a capital gain. If you hold the asset for 1 year or less, it's a short-term capital gain, which is taxed at your ordinary income tax rate. If you hold it for more than 1 year, it's a long-term capital gain. For most investments like stocks, long-term capital gains are taxed at preferential rates, which are currently 0%, 15%, or 20%, depending on your income. However, for collectibles, the long-term capital gains tax rate is different and can be higher, with a maximum federal rate of 28%. Now for a very common point of confusion: the taxation of gold bullion ETFs. These are the ETFs we covered in Chapter 3 that hold physical gold in a vault. Even though these products trade on a stock exchange just like a stock, the IRS generally looks through the fund to the underlying asset. Because the fund holds physical gold, which is a collectible, the gains from selling shares of these ETFs are also typically taxed as collectibles, subject to that same maximum 28% long-term capital gains rate. This often comes as a surprise to investors who assume they will receive the lower tax rate that applies to most stocks. This brings us to a clear contrast: the taxation of gold-related stocks. This includes the shares of gold mining companies, royalty companies, and the equity-based mutual funds and ETFs that invest in these businesses. The IRS views these as standard securities, not collectibles. Therefore, they are subject to the standard capital gains tax rules. Long-term capital gains from selling these stocks, held for more than 1 year, are taxed at the preferential 0%, 15%, or 20% rates. Any qualified dividends paid by these companies are also generally taxed at these same lower rates. Finally, let's touch upon the Gold IRA, which we detailed in Chapter 9. The primary feature of an IRA is its tax-advantaged status. When you buy or sell assets inside your IRA, whether it's a traditional or a Roth IRA, these transactions do not trigger a taxable event. The gains, losses, and any income generated are sheltered within the account. Taxes are only a factor when money is withdrawn or distributed from the IRA, typically in retirement. For a traditional gold IRA, distributions are taxed as ordinary income in the year they are taken. For a Roth Gold IRA, qualified distributions are completely tax-free. To summarize this simplified overview, the tax treatment of your gold investment depends heavily on what you own. Physical gold and physical gold ETFs are generally taxed as collectibles at a higher long-term capital gains rate. In contrast, gold-related stocks and stock funds are taxed as securities at the lower long-term capital gains rates. We must say it one last time: This was a general educational discussion. State and local taxes may also apply, and your individual situation can change everything. Please consult with a qualified tax professional. Now that we have covered the fundamentals and tax implications, it's time to consider the practical side of things. In our next chapter, we will discuss common mistakes to be aware of when investing in gold, and how to approach the topic with a prudent mindset. Thank you for joining us for this crucial chapter. We look forward to seeing you next time. Hello and welcome back to our educational series on the different ways to invest in gold. In our last chapter, we provided a general overview of the complex tax implications associated with various gold investments, emphasizing the absolute necessity of consulting a professional. Today, we shift our focus from technical rules to human behavior, as we discuss common mistakes to be aware of, and the principles behind a prudent mindset. As always, we must begin by stating that this chapter is for educational purposes only. It is an observation of common behaviors and principles, not personal financial advice. Every individual situation is unique, and a sound financial strategy is one developed in consultation with a qualified and licensed financial professional. Having studied the various ways to invest in gold, it's equally important to be aware of the common behavioral and practical pitfalls that individuals can encounter. A primary one is making emotionally driven decisions. This often appears as FOMO, or the fear of missing out. When the price of gold is rising rapidly and is all over the news, the fear of being left behind can cause people to rush in and buy at a market peak. The opposite is also true. During a price correction, fear and panic can lead people to sell at the worst possible time, locking in a loss. A common observation in financial markets is that decisions made out of extreme greed or fear are often suboptimal. A second common mistake is overconcentration. While we've spent this series focused on gold, a foundational principle of modern investing is diversification. This means not putting all of your eggs in one basket. Concentrating too much of one's capital into any single asset, whether it's a single stock or a single commodity like gold, can expose a portfolio to significant risk if that one asset performs poorly. Financial professionals often discuss gold's role as a small component of a larger, well-diversified portfolio that includes other asset classes like stocks and bonds. A third practical mistake is ignoring the total cost of ownership. It's easy to look at the daily spot price of gold, but the true cost can be much higher. As we've discussed, physical gold comes with dealer premiums and potential storage and insurance costs. ETFs and mutual funds have annual expense ratios. Gold IRAs have a multi-layered fee structure including setup, custodial, and storage fees. Not accounting for these all-in costs can lead to a misunderstanding of the investment's actual performance over time. A fourth pitfall is misunderstanding the chosen investment vehicle. For example, an individual might buy shares in a junior mining company expecting it to track the price of gold perfectly, without being aware of the immense operational and geological risks that could cause the stock to fall even if the gold price rises. Another example is buying a gold bullion ETF without being aware of its tax treatment as a collectible. Each of the methods we've covered is distinct, and it's essential to understand the specific characteristics of the one you choose. Finally, a specific area of caution involves succumbing to high-pressure sales tactics. This can be particularly prevalent in the direct sales of physical gold, or in setting up gold IRAs. Tactics to be aware of include creating a false sense of urgency, making promises of guaranteed returns, which are impossible in any market, and aggressively steering individuals towards numismatic or collectible coins that carry enormous markups over their actual gold value. So, what are the elements of a more prudent mindset? First, it involves having a clear purpose. It's helpful to ask the question, what role is this investment intended to play? Is it meant as a long-term store of value, a potential hedge against inflation, or a short-term trade? The answer should guide which, if any, investment vehicle is appropriate. Second is adopting a long-term perspective. Historically, gold's primary role has been as a store of value over decades, not days. Viewing it through a long-term lens can help insulate an individual from making rash decisions based on short-term price volatility. Third is a commitment to due diligence. This means taking the time to thoroughly research dealers, custodians, or fund providers before committing any capital. It means reading the fine print and understanding the fee structures. In conclusion, being aware of common behavioral and practical mistakes is a vital part of a sound financial education. A prudent approach is typically one that is unemotional, well-researched, and has a clearly defined long-term purpose. We have now covered the why, the how, and the what to be aware of. In our final chapter, we will bring everything together, summarizing the key takeaways from our entire series, and offering some concluding thoughts on gold's role in a modern financial landscape. Thank you for joining us. We look forward to seeing you for our final chapter. Hello, and welcome to the 15th and final chapter of our comprehensive guide on the different ways to invest in gold in the United States. For the past 14 chapters, our goal has been to provide a broad, unbiased, and purely educational overview of this deep and multifaceted topic. Today, we will bring our journey to a close by summarizing the key takeaways from the series and offering some concluding thoughts on gold's place in a modern financial landscape. We began our series by asking why gold, and exploring its timeless appeal as a store of value and a safe haven asset. From there, we journeyed through a wide array of methods, each with a distinct profile of risks, benefits, and responsibilities. We covered the path of direct ownership, starting with traditional physical bullion in the form of coins and bars, the most tangible way to own gold, but one that comes with the challenges of storage and security. We then looked at its modern counterpart, digital gold, which offers convenience and accessibility in exchange for placing your trust in a third-party provider. We explored the world of market-based products, detailing gold bullion ETFs, which provide liquid and convenient exposure to the gold price, but come with indirect ownership and unique tax considerations. We contrasted this with investing in the gold industry itself, looking at the high leverage and complex business risks of individual mining stocks, the diversification offered by mining ETFs and actively managed mutual funds, and the unique business model of royalty and streaming companies. We delved into specialized areas such as the rule-bound structure of gold IRAs for retirement planning and the high-risk, complex world of futures and options, which are tools for sophisticated traders, not long-term investors. We even took a detour to understand silver, to better appreciate the unique qualities of gold. Throughout this exploration, several key educational themes have emerged. Perhaps the most important is that there is no single best way to invest in gold. Each method represents a trade-off. Do you prioritize tangible possession or liquidity and convenience? Are you seeking direct exposure to the metal's price or leveraged exposure through the operations of a business? The answer to these questions highlights that the suitability of any method depends entirely on an individual's personal goals, resources, and risk tolerance. A second critical theme has been the importance of understanding the all-in cost and tax implications. From dealer premiums on coins to the expense ratios of ETFs and the multi-layered fees of gold IRAs, costs can significantly impact long-term returns. Similarly, understanding the tax differences between a collectible and a security is a vital piece of the educational puzzle. A third recurring principle has been the importance of due diligence and being aware of common pitfalls. Whether it's researching a dealer, understanding a fund's holdings, or resisting emotionally driven decisions, a prudent approach is one that is thoughtful, skeptical, and well-researched. Finally, we have consistently placed gold in the context of a larger financial picture. In the world of modern financial planning, gold is generally not viewed as a standalone solution, but rather as one potential component in a well-diversified portfolio. Its role, historically, has not been to generate rapid wealth, but to potentially preserve it, and to act differently from other assets like stocks and bonds during times of stress. So, as we conclude, what is gold's enduring role? For millennia, it has been a symbol of permanence in an ever-changing world. While the vehicles for owning it have evolved from ancient coins to digital tokens, its fundamental characteristics remain. It is an asset that is nobody's liability, a store of value that transcends borders, and a potential hedge against the uncertainties of the financial world. And that brings us to our final, and most important message. We want to thank you for joining us on this educational journey. We sincerely hope this series has provided you with a clear and valuable understanding of the landscape. However, we must end by stating one last time, with the utmost clarity. This entire series has been for informational and educational purposes only. It was not, and should not be considered, financial, investment, tax, or legal advice. All investments carry risk, and the world of finance is complex. Before making any decisions, we strongly, and without reservation, encourage you to seek the guidance of qualified, licensed professionals who can understand your personal situation and help you navigate your own financial path. Thank you for your time and attention. We wish you the best in your continued journey of learning.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, You agree not to hold the creator liable for any loss or damage arising from your use of the information provided.